How do pivot points strategies perform under various market conditions? Pivot points strategies are adaptable to various market conditions. They can be effectively used in both trending and ranging markets to identify potential turning points or areas where price movements might pause or reverse. Pivot points strategies are adaptable and can be effective in both volatile and stable markets. They provide clear, quantifiable levels which are especially useful in directional markets, helping traders to identify potential turning points or continuation patterns. However, their effectiveness can vary in extremely volatile markets where price movements are less predictable. What risk factors are involved in pivot points strategies? The risk factors in pivot points strategies involve mitigating risks with clear support and resistance levels. While pivot points provide structured levels, the challenge lies in correctly interpreting these levels and responding to false breakouts or unexpected market moves. The risk in using pivot points lies in the possibility of price movements breaking through these levels unexpectedly, leading to potential losses. However, the strategy provides a clear framework for setting stop-loss and take-profit orders, helping traders manage their risk exposure. Understanding how to interpret these levels in the context of prevailing market conditions is key to mitigating risks. What are the potential rewards of employing pivot points strategies? Key potential rewards of employing pivot points strategies come from gaining from accurate level-based trading. By accurately identifying and trading around these pivot levels, traders can capitalize on price movements between these points. The reward potential of pivot points lies in the successful anticipation of price reactions at these key levels. The best case scenario is accurately predicting whether prices will bounce off these levels or break through them, leading to profitable trading opportunities. However, traders should be aware that not every pivot level will result in a significant price reaction, and average returns will depend on market conditions and the accuracy of the pivot point calculations. What considerations should be taken into account when implementing pivot points strategies in futures trading? Key considerations when implementing pivot points strategies include applying pivot points effectively. This involves understanding how to calculate pivot points, integrating them with other technical analysis tools, and recognizing how price reacts at these levels in different market scenarios. Implementing a pivot points strategy effectively involves calculating the pivot point and support/resistance levels based on the previous day's high, low, and closing prices. Monitoring price action around these levels during the trading day to identify potential entry and exit points. Combining pivot point analysis with other technical indicators or chart patterns for a more comprehensive trading approach. Setting stop-loss orders just beyond the identified pivot levels to manage risk. Being aware of market news and economic events that could influence price movements and impact the reliability of pivot levels. Pivot point strategies in futures trading require a systematic approach and an understanding of how prices tend to behave around these key levels. Traders should be prepared to quickly adjust their strategies based on how the market reacts to these points, making it a dynamic and potentially rewarding approach for those who master it. What are some stock option trading strategies? Let's take some time to cover some of the strategies. Using covered call to speculate in stock options. This involves holding a long position in a stock and selling a call option on the same stock. The goal is to generate income from the option premium, especially in a flat or slightly bullish market. What is the primary objective of the covered call strategy in stock options trading? The primary objective of the covered call strategy in stock options trading is generating income through option premiums. By selling call options on stocks that the investor already owns, the strategy aims to earn premium income, supplementing the returns from the underlying stock. The primary goal of the covered call strategy is to generate income through the selling, otherwise known as writing, of call options on a stock that the trader already owns. This strategy is particularly geared towards income generation, leveraging the option premiums received as a source of earnings. It is less about capital appreciation of the underlying stock and more about earning from the options market. How does the covered call strategy perform under different market conditions? The covered call strategy performs optimally in flat or mildly bullish markets.